Hello, vloggers. Today, for our first vlog of 2024, we have one of the best analysts on the market. We use him regularly. He's from Banyan Investment. Zach, how are you?
Yeah, good afternoon, John. Thank you for your kind words.
Mate, Happy New Year. How you been? How did you have how was your break?
Yeah, it was very good. Spent it north and Gold Coast with the kids and family. And so, yeah, it was a pretty good holiday, gearing up for a very interesting year in the markets.
Oh, fantastic. Now, let's kick off. The way I look at things is you got to have a look at the past to have an idea what might come forward. So give us, in your opinion, a wrap of 2023.
Yeah, look, let's focus on the Australian market. It was quite interesting because the Australian market, if you look at the ASX 200, ASX 300, pretty much we're having a very lackluster year for the majority of it. So, I mean, year to date, end of November, the ASX 200 was only up about 4.5% or thereabouts. It was really that December where the market kicked up by 7.2%, that delivered an overall total result of 12.8% for the year for the Australian market, which ended up being a pretty attractive year for investors, and that included about 8% price plus about 4% in yield or thereabout. And what you really had was towards the end of the year, I mean, what really kicked off December was quite frankly the US Fed, where they pretty much came out a lot more hawkish. A lot more dovish than the market was expecting. The market was already expecting some cuts, but they very explicitly came out and said, we're looking at 3 cuts next year. Now, for mine, I really didn't think they needed to do that because financial conditions were easing already. So, bond yields were already declining. They took a crash down in December. Liquidity from across all the central banks that we follow, that means all the major central banks, was actually ticking up since October lows. And the US dollar, which hampers ex-US growth with a high US dollar, was declining as well. On top of that, they basically came out and said, well, we're going to start cutting rates. And that put an absolute rocket into the market. And what you saw was, if you went last December, and I was looking at the numbers, the laggards in some of the sectors like REITs, consumer discretionary, really came back. So the deep sold off value stocks in the December month. So overall, what you really had was a lackluster year. December, basically, the real value plays over the year caught up. And in the end, you'll be surprised. Technology obviously did very well last year for ASX 200, 30%. We've got a very healthy exposure to technology. But investors may be surprised that the second best performing sector was actually consumer discretionary. Remember, rising yields, rising mortgages, the very fixed to variable, the world's going to collapse. Well, guess what? That kind of, the end was quite different to what people had expected. So that's how last year panned out.
It sure did. That's what we that's what we noticed as well. I mean, in our opinion, 2023 was always about the Fed and what's going to happen with interest rates. Now, looking to 2024, what are the key macro themes? More of the same, what the Fed's going to do, interest rates. What's your opinion?
Yeah, look, unfortunately, whether we like it or not, John, directionally, what the Fed does and says will set the tone. So the biggest catalyst is still what the Fed does. I think they probably walk back some of that dovish talk that they went with in in December. And I mean, the market's expecting about 6 to 7 cuts in the US. I think that's going to be aggressive. I think what you probably see is market pull back some of those expectations. And I'm seeing the recent last couple of days of market coming off. There's definitely profit taking, but there's also, I think people just saying, I think 6 to 7 cuts is too much. We should pull that back a bit. So I think that would be a big catalyst. Another big catalyst I think you've got to really appreciate is that the market consensus is definitely on a soft landing narrative. And, look, we were listening in on the JP Morgan results, the Bank of America results, the Wells Fargo results. The Bank of America CEO basically said the checking accounts, the saving accounts for its clients are still some 30% above pre-pandemic level. So there's still buffer there. So if that soft landing narrative actually materializes, then the number of cuts required will have to be pulled back, and that means some volatility in the equity market. But over the course of 2024, I think we're likely to see all-time highs before some pullback, and you're likely to see a 5 to 7% return over the year for markets with a lot of volatility. Now, let me back that up with a little bit of historical context. If you look at US presidential elections, year 1, year 2, year 3, year 4, so we're in year 4, we've got elections at the end of the year. Very rarely, I think zero, have you seen a negative return in the fourth year of the presidential cycle. Number 1 is normally a pretty good year. Number 2 is normally a lackluster. Number 3, which is last year for us, is normally the best year, and we got a really good year. And number 4 on median return is about 7%. And the simple theory, I mean, just thinking out loud, is that heading up into the election, what you're likely to see is everything being thrown at the voters to capture their votes into the presidential election. So you'll get markets rallying up with some volatility, and then towards the end of the year, as things start to settle down, who wins, and we really get a feel of who will really be elected and what kind of policies they'll have, you might see a bit of pullback in the markets, but that's the kind of road that I'm taking. Finally, I will say this. I'm personally, the way I'm investing this year is taking it on a quarterly by quarterly basis. Mm-hmm. Follow the data, both live data and historical data, and I think assess the market and the economy on a quarter by quarter basis.
So, Zach, as you're well aware, it's been a dreadful 2 years for the small cap sector. Yeah. Here at Redleaf, we're telling our clients that 2024, given the rate cuts that we anticipate, will be the year of the small cap recovery. In your opinion, is that a fair assessment? Would you agree, or do you have a slightly different view on that?
Well, I think from a valuation perspective, they already are looking very cheap. So the further downside from here is really, I mean, some of the companies, we've looked at together, we look at independently, they're very profitable companies. They've got cash flow, they've got earnings, they've got visibility, and they've got growth baked in because of the kind of contracts and the business models. So there are a plethora of companies out there in the small caps who've just been sold with the broadest market sentiment. That's what we've experienced. But as you know, as well as anyone in the markets know, valuations can only hit a certain level before people just say this is too cheap. So if the consensus narrative materializes, 5 to 6 rate cuts, you're going to see some material returns in the small caps because the large cap is so overcrowded. And look, they're overcrowded for a good reason because they're good quality companies. But at some point, the valuations will have to start to come back there, and there needs to be a bit of catch up. So I think it's a stock pickers market. Pick well within small caps. That's where the opportunities are, and manage your risk. But yeah, I certainly would agree. That's the part of the market that looks very interesting. And more specifically, honestly, John, micro caps. Yeah, where the business models are simple, the line of sights are simple. There's not too much, forecasting that you have to do in terms of multiple business lines, multiple expense line, and you find management are generally very honest and upfront with the prosperity of the future prosperity of the company. I think micro caps could be a very interesting space.
Mate, we sure hope so, because that's our specialty over here at Redleaf. Now, before we'll discuss one of the micro caps that we know that you love. I want to ask you, in your opinion, which sector do you feel outperform in 2024 in any asset class?
Yeah, look, that's an interesting one. I think if I look at let's look at a couple of sectors that have done really well. I think consumer discretionary, which has come back. I think there's still some nervousness around how the consumer in Australia. Remember, our mortgage setup, our cost setup, and our wages growth setup is much different to the US. So you've got to be really, really mindful of that. And I think consumer discretionary, I will be definitely looking to take some profits and looking at really deep, hard into how their earnings are looking. I think REITs, that significant sell-off that the REITs experience, that deep value valuation has largely been closed. I think materials may potentially surprise on the upside in terms of earnings, because if you look at where the spot rates are for, you know, some of the markets, like some of the sectors like iron ore, oil, some of the forward-looking consensus forecast for these commodities is for a decline. So if these spot rates hold up, you may actually see a little bit of upside risk to earnings to consensus, because they're expecting a decline. So overall, I think banks may also surprise on the upside. And I'll tell you why, because I think if you look at the latest APRA numbers in November, some of the more aggressive guys out there like ANZ, who are really going after the market share, seem to have come back to system level growth, which kind of insinuates that there may be a little bit of rationality appearing back into the mortgage market. I'm not saying it's completely removing, gone away competitiveness, but I think a little bit more rationality may just improve the bank's earnings as well. Well, certainly from what for what consensus is expecting. But I think the biggest opportunities I see again is the industrial sector, where you will have to be picky. You know, the micro, and within that sector, I don't think there's one particular sector I'd call out. I think it's a broad base. That's where I'd be looking.
Okay, so let's be a little bit more specific now. We know you love this stock. We love this stock too. Your pick of the year, from my understanding, is Findi Ltd. The ticker is FND. Tell the viewers why you love it.
Look, it's very simple. When I first came across Findi, it first of all very much fit into my top-down narrative about India. Look, I remember having a conversation, John, with clients 5 years ago, or three to 4 years ago, and the question was, and banging the table on India, it's a bridge too far for us to climb. Well, now, like I put it, everyone's trying to get over that bridge, because India's a new story rather than China. So from a top-down macro perspective, I've always liked the India story. I continue to like the India story, and I think there is a lot to like about India over the next 10 years, or this decade anyway. So one of the points that I've highlighted, and this is again no rocket science, those that follow the story from a macro perspective understand that India has just hit that inflection point in its consumption. So one of the measures you use is the GDP per capita. So if you go back to China back in 2006, when the consumption lifted in China, because it hit the US $2,000 per GDP capita. And what that meant is it's a sign of a healthy economy. It's a sign of a healthy consumer. And that's where the internal consumption story really takes over. So when you bring that back, I think barring what's happening recently, because I've been reading reports, the top level, the top 20% of Indian consumers, the growth there is still pretty steady but moderating. And the bottom half, they're feeling some pressure. Inflationary pressures are coming through. There's a bit of a step down in the quality of products and the purchasing power. But if you look at over the next 10 years, this government is very stable. Policies are very much consumption-led and internally generated. And then also from an external perspective, a lot of the companies are investing in India. All the big global companies are investing in India. And I think from a macro perspective, that sets up really nicely for companies like Findi. So what does Findi do? Findi does ATM solutions and digital payments. Again, you've got to understand the nuances of the market they're operating in. Most people go ATMs. What, is this the 1990s? No. ATMs is still very, very relevant in India because cash is still very, very relevant in India. Let me give you one simple statistic. People that order online in India still pay cash on delivery. They're not using credit cards, right? Because, there's theft and stuff. So they don't want to put their credit card details on there. So they're using the Amazons. They're keeping up with the digital age. They're not going backwards, but they're saying, I will pay you when I see the product on my front, and I'll pay you in cash.
Zach, so, I'm hearing, I'm of Greek background. I'm hearing it. We pay cash.
Exactly. I'm from the subcontinent, and this is why I understand it straight away, right? So, and that's important. So the ATM solution business has a long runway, because don't forget, India is still a low middle income nation. It's still got a lot of runway to go. Like I said, India is where China was in 2006. So given as long as the Indian government do not really mess this up from a policy perspective, they've got the runway. So cash will be king, and there's a good runway of 10 years. And Findi's just locked in a 10-year government 10-year contract with a client, and the numbers are just staggering. So there's earnings visibility. And then you've got the digital business. Hey, we're all on the digital business. Everyone needs to get on board. And I think the latest, update by Findi, they're really going out there and acquiring merchants. So what they do is they're basically digitalizing the merchants, the mom and pop shops around the corner, which are still very important in places like India, because that's where the locals go. So you've got this cash cow of ATMs, and then you've got this emerging digital business, which everyone needs to move to. And you put that together, you got earnings visibility. So the company has guided towards 24% revenue growth, 41% EBITDA growth, and positive EBITDA cash flow of $20 million. I'll take that going into a year where we don't know how things are going to pan out.
Yeah.
So that's the kind of stories we like.
Same here, Zach. We really respect your insights. We value as probably the best analyst in the market. Have a great 2024, and thank you for your time.
Thanks, Sean. Appreciate that.
Cheers, mate.